All right, let's talk about something that sounds almost too good to be true, making money while you sleep. No, seriously. We're diving into dividend investing, and I'm going to show you how it all works, even if you're starting with, well, nothing. So let's get right into the big idea that makes this whole thing tick.
Just let that sink in for a second. Imagine waking up, checking your phone, and seeing money in your account that you didn't have to work for. That's not a fantasy. It's what happens when you stop trading your time for dollars and start letting your money work for you. It's a total game changer, and that's exactly what we're digging into today.
Okay, so first up, what in the world are dividend stocks? Let's break it down. Super simple. A dividend is basically just a thank you payment. It's the company literally sharing its profits with you, its part owner. Think of it like getting your slice of the pie just for being an investor on the team. Pretty cool, right? So picture this. A company makes a big profit. Now they've got a choice to make. They can either plow that money back into the business, build a new factory, invent the next big thing, or they can share the wealth with the people who own the company. And guess what? That's you. When they choose to share, that's where dividends come from. And this is so important to get. You're not just buying some random letters on a screen. You are literally buying a tiny piece of that company. You become a part owner, and that ownership gives you a legal right to a piece of the profits. All right, so you own a piece of the company, great. But how do you actually get paid? Well, there are count them, two ways you make money here. So here are your two money makers. First, you've got the dividend itself. That's cold, hard cash landing in your account, usually every quarter. The second way is what we call capital appreciation. That's just a fancy way of saying the stock itself becomes more valuable over time as the company does well. And that's why this is so awesome. You're getting paid just to wait. While you're holding the stock and letting it grow in value over the long haul, the company is sending you cash payments. I mean, come on, it's the best of both worlds. Okay, we've covered the what, so now let's get to the how. You can't just pick any stock. We need a strategy, and it's all about finding what I call a safe yield. Now, it's really tempting to just look for the company with the biggest, juiciest dividend. But trust me, that's often a trap. A super high yield can actually be a huge red flag that the company's in trouble. The real goal here isn't the highest yield, it's the safest one. So, how do we find these safe bets? I've got a simple 3-step checklist for you. Let's walk through each one. Step 1, look for the Dividend Aristocrats. These companies are the absolute legends of the investing world. We're talking about businesses that have given their shareholders a raise by increasing their dividend every single year for at least 25 years straight. That's just wow. It tells you they are incredibly stable and well run. All right, step 2 is checking something called the payout ratio. All this means is what percentage of their profits are they paying out as dividends? And the magic number you're looking for is under 60%. Why? Because if a company is paying out, say, 90 or 100% of its profits, it has nothing left to grow the business or to save for a rainy day. It's just not sustainable. A healthy company finds that sweet spot. They give a nice chunk to you, the shareholder, but they also keep a healthy portion to put back into the business. And that's crucial because that's the money that fuels the growth that lets them give you that pay raise next year. And last but not least, step 3, check for consistency. Look, any company can look good when the economy is flying high. The real test is what they do when things get tough. Did they keep paying dividends during the last recession? Or did they cut and run? You want a partner for the long haul, not a fair weather friend. Okay, we've got the basics, we've got the strategy, but now we get to the secret sauce. This is the part that takes this from a nice little income stream to a true wealth-building machine. So what is it? What's the one thing that can take a small, modest investment and turn it into a massive fortune over time? The answer? Well, it's actually incredibly simple, but its power is just off the charts. It's something called a DRIP, a dividend reinvestment plan. And here's the magic. Instead of taking those dividend payments as cash, you just tell your broker to automatically use that money to buy more shares of the very same stock. So your dividends buy more stock, which then earns you more dividends, which buys you even more stock. You see where this is going. This is the famous snowball effect. Think about rolling a tiny snowball at the top of a huge snowy hill. At first, it's small, but as it rolls, it picks up more snow, gets bigger, and starts moving faster and faster. That is exactly what happens to your money. It just builds on itself faster and faster over time. And just look at the difference this makes over the long run.
It's not just a little bit better, it's absolutely mind-blowing. Reinvesting your dividends is the difference between having a nice little bonus and building actual life-changing wealth. This right here, this is the magic of compounding in action.
So let's be super clear as we start to wrap this up. This is not a get-rich-quick plan. It's not going to happen overnight, but it is, without a doubt, a get-wealthy-for-sure strategy if you have the patience for it. So what's your game plan? It's really this simple. 1, just start, even if it's small. 2, be consistent, make it a habit. And 3, the most important part, be patient. Let time and that compounding snowball do all the heavy lifting for you. So, there you have it. The blueprint is simple, the strategy is solid, and the results, well, they speak for themselves. The path is right there in front of you. Your first dividend check is just waiting to be earned.